Good morning. My name is Jim Barrett. I'm responsible for the institutional business at Baron Capital, and welcome to our 30th shareholder gathering and also the 840 panel. I think at this point it'd be great. I'm just going to have the portfolio managers do a brief introduction of themselves, and we'll get directly to your questions.
Good morning. I'm Neal Rosenberg. I co-manage Baron Growth Fund along with Ron. I've been with the firm since 2006.
Hi, I'm Andrew Peck. I've been at the firm since 1998. I manage Baron Asset Fund, which is a mid-cap focused growth fund, and I'm also the co-chief investment officer alongside my colleague Cliff Greenberg.
Hi, I'm Michael Barron. I've been at the firm since 2004, I think it is. I'm the co-portfolio manager of Baron Partners Fund, which is an all-cap concentrated portfolio that uses a little bit of leverage.
And David Barron, I co-manage the Baron Focused Growth Fund with my dad, and been at the firm since 2005, been co-managing since 2018.
Thank you. I figured maybe we'll just start with one quick question from up here, and then we'll go to your questions. I was going to ask our Co-CIO, Andrew Peck. It's been a volatile year in the market, I mean, throughout the entire market, but specifically in the small and mid-cap space.
I've noticed.
How has that affected your view in terms of managing or structuring the portfolio?
Well, I guess the way I think about volatility, to be honest, in many respects, volatility is never fun. But given our long-term oriented approach, in many ways, it's a long-term blessing for us. And what I mean by that is that we're purchasing stocks with the expectation that we're going to own them for a very long period of time, and we're trying to purchase stocks that we think have secular growth dynamics associated with them, meaning they're going to grow somewhat irrespective of the underlying economic conditions over time. And I think what's been most sort of prevalent in the volatility we've seen is uncertainty from investors' perspective as to whether interest rates are going up or down in the near term and whether or not there's going to be a recession sometime soon. And from my perspective, and I think the perspective of all of us, those are two factors that are largely unknowable. And so to the extent that those are causing stocks, in many cases, to go down for discrete periods of time, that gives us opportunities to take advantage of that near-term uncertainty, volatility in the market, to establish or add to positions that we think have attractive long-term return potential, irrespective of whether or not interest rates are at 3% or 5%, whether or not there's a recession in 6 months or not.
Thank you. At this point, this is your time, so be happy to take questions from the audience. And if I could figure out this iPad, which has gone a little crazy on me, there's other questions I know that are streaming in, but feel free to start. Great, thank you.
Yeah, Alex Amansky just did say a fairly controversial statement right when you were walking in about the private investments. So specifically for the Baron Asset Fund or anybody else that wants to speak to it, I know SpaceX is a fairly large holding in that fund. What was he referring to specifically that was problematic about private investments, and how do you view it?
You want to talk about privates just in general?
Sure, I'll start and then perhaps you can talk about SpaceX. So I think what Alex was referring to was the idea that, our, sort of day job is investing in public stocks, and there is, a whole sort of process and methodology that we, sort of follow to do so. Investing in private companies, generally speaking, entails a different set of skills that I think many of which we as a firm and as analysts possess, but some of which perhaps we're less sort of polished or experienced in than people who focus on private investments as sort of their full-time occupation. And so I think the point he was probably making is that on a going forward basis, unless there are sort of truly differentiated aspects associated with a particular private investment, and unless there's something about that private investment or company that dovetails well with our research process and the relationships that we formed as a result of being active public market investors in particular industries and companies, it's probably better on a go-forward basis for us to be less focused on private investments. With that being said, and I'll turn it over to Michael, SpaceX, as you referenced, is a private investment that is held in 3 of the funds here that are represented here. And I think there are unique dynamics associated with that investment, which caused us to make it. And maybe Michael wants to touch on that.
Sure. I don't know exactly what. Sorry, I don't know exactly what Alex said. Didn't hear him, but I'm sure he always has great comments, and controversial comments are always fun. Thank you, Alex.
Surprising for him.
Right. And he's probably right that typically they aren't appropriate for most mutual funds. We view SpaceX as a little bit differently. We do just as much diligence, if not more, on this investment than we do with all our other investments. We treat it the exact same way. We price it on a daily basis. So a lot of other funds out there mark a stock or mark a private investment and let it sit there, never going up and down. We try to mark this on a daily basis because we do provide daily liquidity to our shareholders. We really like SpaceX, so it's an 8% position or so in Baron Partners Fund. We're a little limited in terms of what we can say because we have a pretty firm NDA, a non-disclosure agreement with the company. But we do think that this company will have the ability to have liquidity, which other private companies typically do not. I don't know how much everyone here knows about SpaceX. They have kind of 2 business breakdowns. They have the launch business, which is the cool stuff everyone sees on TV, the rocket going up and coming back down. But then they have the Starlink business, which is basically going to be providing internet connectivity to everyone around the world. Basically $500 for a dish, you can get internet connectivity. It costs around $15,000 to $17,000 to drill an extra mile of fiber. It's uneconomical to do fiber anymore. Dish is the best way, satellite's the best way to do it. So we think that business will eventually go public probably in the next, call it 2 years. And that should give our shareholders some liquidity, and therefore, we have a pathway to becoming a public company.
Questions? See one right over here.
Hi, this is to Michael. Last year, I thanked you for the great returns for my family that you and your father have done in the 20 years I've been in Partners Fund. And again, thank you for this year. But I noticed this year, at one point, you're up a lot more than you are now. You're up about 22% year to date. But the funny thing is, and this is similar to the question I asked at the first panel, Morningstar has taken your fund from a 5-star rating down to a 2-star rating. But yet you're still up 22%, which in my view is still outperforming everything else I look at. Why do you think that is?
It's a good question, interesting question. We don't try to manage the fund to outsiders' perception of us. We're managing the fund based on what we think will generate the best long-term returns and for our shareholders. This fund is volatile. It's a highly concentrated portfolio. It's 24 names. The top 10 account for around 85% of overall gross assets. Use a little bit of leverage, around 15% currently. All those things together, there is some volatility, and Morningstar might be anti-volatility. Look, we're trying to find clients who understand what we do and how we do it, and as a result, trying to find investors that are thinking about retirement, essentially. What's their assets going to be, not in a year, not even in 2 years, what's it going to be 10 years, 20 years down the road when you need those for retirement. They might be a little bit more short-term focused. I can't speak for them, but we're not trying to manage the portfolio in any one way to get a certain rating or ranking by Morningstar.
I saw a question up here in the middle.
I've always been impressed with y'all's ability to get to know the CEOs and leaders of companies. Has the last year changed your opinion of
Of Elon? Want to do it?
I don't know. Could you repeat that question? I'm sorry. Could we get a microphone over here, please, in the center?
I got it. Has our opinion of Elon changed?
Oh, okay.
Essentially, that's what you're asking? No. Quick show of hands. Who was here last year when Elon spoke? Wow, we have a lot of return attendees. Thanks for coming again. It was so interesting after the conference last year when people actually heard directly from Elon. The comment most people made was he is totally different than the perception you see of him on the news, on TV, and in magazines or newspapers. He is a thoughtful person, a mission-driven person. Each one of the things he does, each one of the companies he's involved with has a very clear, defined mission. And he's kind of driven by that principle. So yeah, he does some things that I don't necessarily always agree with, and look, the same way I don't agree with what Morningstar does with our rankings. I don't agree with every single thing that Elon does. But I still like him as a person. I think he's an ethical, hardworking, extraordinarily hardworking, trustworthy person. And we like what he's doing at each of the investments, mainly Tesla and SpaceX.
I have a question for Neal, actually a streaming question that came across about the Baron Growth Fund, which recently has had a higher level of financial exposure than the benchmark. I mean, can you talk about this, especially given the higher interest rate environment that we're in?
Sure. Baron Growth Fund does, relative to our benchmark, which is the Russell 2000 Growth, have a relatively higher weighting, or much higher weighting than the benchmark in the financials category. First of all, our portfolio is constructed from a fundamental bottoms-up perspective. We are not, we like to say we're benchmark aware, but benchmark agnostic. We're certainly not making an intentional bet. Stocks like that are categorized by GICS. We don't, I think someone on the previous panel, touched on this briefly. We don't necessarily agree or disagree, but we use that as a reporting tool and not a management tool. However, what's important to know is that none of our investments are contingent upon making any discrete call or having a discrete view on interest rates. And while approximately 39 or 40% of the portfolio is classified as financials, almost 60% of that exposure is actually is in stocks that we would consider to be financial technology or market data businesses, one of whom FactSet is here today. GICS would consider that to be a financial company, but they purely provide data, analytics, and insights used by a broad array of market professionals. That subset of the portfolio, which includes MSCI, FactSet, Morningstar, a couple others, have enviable business models, none of them take credit risk, none of them are making markets or have direct or any sort of direct or adjacent financial exposure beyond being sold to clients that tend to focus on financial end markets. And interestingly enough, as you look at their compound returns over cycles, each one of them has generated revenue growth anywhere from mid to high single digit towards mid-teens revenue growth, and consistent EBITDA margin expansion, whether interest rates were 5%, 0%, anywhere in between. The other half of the financials exposure, or 40% of the financials exposure, is in insurance or differentiated insurance businesses. Again, Kinsale Capital, who may be presenting while we're here, so I guess you chose not to go and see them to hear us, but they are here and articulating their space in the E&S subset of the P&C market, and we also own a couple of what we believe are differentiated advisor businesses. So it's been it is a large overweight versus the benchmark, but we think it looks very different as you sit and talk and think about the exposures that we actually own, and has been a tremendous source of alpha over the life of the fund.
Questions out there? See one over here on the right.
All the panelists are talking about the volatility in the market. Do any of the Baron funds incorporate a basic option strategy, such as covered calls?
David, would you like to take that?
No.
With pure public equities, public equity firms investing small, mid-cap, large cap. We don't do futures, options, currency, FX. It's just pure public equities.
Ironically enough, we have a question on focused growth, and the relative concentration of the portfolio. Do you have a view on concentration as it relates to the overall risk? Is there a way that you try to manage the concentration risk? Maybe you can make a comment or two on that, David.
It is a focused fund, but it is actually diversified through sectors. We manage the fund between 20 and 30 stocks in the portfolio. Right now, it's skewing towards the high end of that, around 30 stocks. But that's just because we see so much opportunity in the market right now, and a lot of stocks are pricing in pretty significant declines in earnings next year. And we think a lot of people are pricing in recession scenarios, and everyone's negative. And it's impacting these stocks. And we see opportunities in a lot of companies. Companies are still growing through whatever recession or slowdown we're going into. And yes, things are slowing. They're definitely slowing. But I think a lot of that is priced into these stocks, and we're taking opportunities to increase our positions and increase our stakes in this focused portfolio. And if you think a focused fund is actually riskier, if you look at the beta of the portfolio, it's actually 80% as volatile as the market. In up cycles, we tend to keep up with the markets. We get about 100% of the upside. We keep up with the markets. But in down cycles, in recession scenarios, slowdowns, we actually lose 80% of what the market does. So we're actually generating really strong returns for less risk. And as a result, the fund has been able to outperform about 500 basis points over the index through its inception the past 27 years.
Couple of questions over here.
Thank you. Good morning. So you mentioned taking advantage of market volatility. I'm just curious, as portfolio managers, when that occurs, you're usually fully invested. So when opportunities arise, do you tend to think about selling a stock, a holding that has done well, or a holding that has not done well? That's one question. Another one is just looking at the returns of the indices, 2000, small cap, mid cap, large cap. Large cap has trounced small cap and mid cap. Is that destined to continue? Is there just a structural advantage that large cap companies have? And then last, for David and Michael, are you comfortable disagreeing with your dad on investment decisions?
It'd make for interesting Thanksgiving when you do.
Maybe we'll start with Andrew.
Right. Okay, remind me which question you're asking me to start on.
This has to do in the volatile market.
Sure.
I think you kind of covered this before.
Sure. Yeah, I guess what I would say is, I mean, each situation is unique, and there are no, sort of concrete rules or one-size-fits-all sort of perspective on this. But what I would say is that, yes, in a nutshell, I mean, volatility can work both to our advantage and disadvantage, meaning, in certain cases, volatility means certain types of stocks become very much in vogue for a particular reason, such as interest rates being at low levels causes certain types of growth stocks in particular to, in many cases, spike, and that might be an opportunity for us to take advantage of what might be sort of an irrational price in the near term to reduce our holdings and to redeploy that capital into companies which might be relatively disadvantaged by that type of sort of macroeconomic environment. And as it relates, I think, to part of your question, whether we sell stocks that have gone up or stocks that have gone down, again, there's no sort of hard and fast rule, but what I would say is that I think all of us try to manage our funds in a way that is tax aware, such that if there are stocks that we own that have gone down and might have a loss on our books, we will try to take advantage of that where appropriate to lower the ultimate tax distribution that our funds make.
I'm thinking, given that you're on our flagship small cap fund, maybe you could talk a little bit about the divergence of performance between small, mid, and large, and kind of our view on that.
Yeah, sure. Let me at least touch on that briefly. I think, first and foremost, a tremendous driver of large cap returns this year has been, the dramatic outperformance of the 6 or 7 largest stocks in the market, all of which have benefited from, real enthusiasm, by and large, real enthusiasm around AI. You've seen NVIDIA. NVIDIA has been sort of the flagship or the bellwether of that movement. I think certainly small and to a lesser extent mid-cap stocks have underperformed to us. We view that as an opportunity. We do not view that as a condition that will necessarily continue on a go-forward basis. I think a lot of that underperformance, even moving beyond sort of the dramatic outperformance of those 6 or 7 largest stocks, has been a function of rising concerns around the macroeconomic cycle, and necessarily smaller cap stocks that tend to be riskier, more sensitive to changes in the macro environment or in interest rates, and more speculative tend to underperform in those sorts of risk-off or in those sorts of environments, and then tend to rebound and outperform on the way up. What we try to do is, I guess, within Baron Growth Fund, we take, first of all, we're looking for businesses, that, we don't look specifically at the benchmark. We're looking for businesses that meet our investment criteria, which includes things like large addressable markets, positive secular trends, high barriers to entry, recurring revenue, high margins and higher incremental margins, strong free cash flow conversion. Those are ultra high quality businesses. Frequently, they will be, because of the vicissitudes of the market or, different factors or, as we discussed, the generic underperformance of small cap stocks, they will decline just because that basket or that segment of the market is declining. And, we view that as an opportunity. We've used that opportunity to initiate several new positions of names that we think meet all of our investment criteria, but are necessarily more attractively valued, and we expect will be very additive to our returns over time. Despite that, despite the underperformance of small cap stocks, the fund has been very successful on a relative and an absolute basis, on a year-to-date basis. On a year-to-date, prior 3, 1, 3, 5, 10, and since inception. So our view is that, we've continued to outperform relative and absolutely across all markets, and when there is an inevitable catch-up trade within the small cap and ideally mid-cap space, that will be incrementally additive to our forward-looking results.
If I can add on to that for 1 second, the one fund that I am a co-manager of that I didn't mention was Baron WealthBuilder Fund, which is an equity allocation fund of Baron funds in general. So if you like what you hear from all of our panelists, Baron WealthBuilder is the fund for you. What's interesting about Baron WealthBuilder is our heritage is in small and mid-cap growth investing. That's where we find the most opportunities, most runway for growth, most upside in investments. We've been out of favor, as you mentioned, over the past 5 or 6 years. It actually started, almost 6 years ago now. Yet even when we're out of favor, this is the #1 fund in its category, the equity allocation category. And yet 2/3 or 70% of our assets are in small and mid-cap growth investing. Out of favor, yet #1 fund. As Neal was mentioning, it's understandable why the large caps are doing so well. People are nervous, and when people are nervous, they weather towards the bellwethers, and these are considered the bellwethers, and they have interesting growth opportunities with AI, and there's a fun other buzzwords these days. Small cap and mid cap will come back into favor, and I think we are extraordinarily well positioned to do well on both an absolute and relative basis when that happens.
Question here?
Oh, you wanted to ask about differences between us and disagreements and our dad. Look, we're 2 sons. We definitely disagree with your dad. I think everyone probably who has kids agrees that their kids disagree with them a fair amount of time. We're not clones of our father. We respect him. He's an incredible mentor to us, an incredible mentor to the 44 other investment professionals that we have at Baron Capital. But each person here is unique, and they see companies differently. And that's what makes Baron Capital special, is that you can have those, they're never heated arguments, disagreements, but there's different points of view about what is a company doing, how is a company valued, and we sit there and debate it. And people often ask, well, how are you different than your dad? You must be, you're younger, so you must be more tech, more high growth, blah, blah, blah. I almost think the opposite. It's amazing. For a guy who's obviously older, he's the one that sees these big picture, these big growth opportunities ahead of him. And maybe I'm a little bit more on the other side. Hey, we should be pairing it with some interesting financials, some more steady growth companies. And that's how we kind of construct a portfolio. So if we were all one kind of company, all these shoot at the lights, as you were talking about earlier, with the volatility would be even greater, and we wouldn't be able to survive. But if you have the right amount of balance and the right amount of different ideas, I think that builds a great holistic portfolio. I don't know if you have anything else to add.
I agree with Michael. I mean, I think I work with my dad. We work really well together. We're a really good match. We maybe think differently sometimes, but share ideas and kind of come to agreements and figure out what to buy and what to sell and how to manage portfolio. And we work really well together. He's taught me a lot, and I've hopefully helped him, shown him some new things too. But it's fun work. Obviously, it's fun working with your dad. So.
I know we have a question over here. I see
Yes.
lots of people waving.
Yes. In the front page of the Wall Street Journal this past Wednesday, headline was EV makers resort to discounts to combat waning demand. Tesla has slashed prices this year across its lineup, reducing the starting price of some models by about a third. Obviously, this is going to affect their revenues and their future profits. The Partners Fund was down 2.7% last night, and Tesla dropped over $12 a share. Would you please address why, or are you going to review the strategy of maintaining 47% of the investments in the partner funds in Tesla under these circumstances?
Sure. You want to do it for me? I can't say what we're doing currently, but we have not sold in the past quarter. And we sold maybe about a year and a half ago at a pretty similar stock price where it is today, but the business is much smaller. Look, this is a business that's doing around 2 million vehicles a year. They're nowhere near their potential. We're not trying to buy or sell a company based on what they're going to do in any one given quarter, any one given year. They're about doing volume. They're about, how do we get from 2 million vehicles today to 20 million vehicles? The only way you do that is by producing a mass car. Generation 2 is coming, and they are working on getting a significant amount of cost out of the system. How do you take $10,000 to $15,000 of cost out of the vehicle? How do you make it more compact? How do you streamline manufacturing? How do you reduce the cost of the battery? This currently is noise. Look, I think we can all agree the economy is not great. Interest rates are high. We need affordability of these vehicles in the short term, and that's what's being achieved by some of these cost reductions. The interesting thing is the other guys can't do it. So we're reducing costs, yet still profitable. Ford came out recently and said on their EV lines, they're losing 70% of the cost of the vehicle. 70%. So instead of selling an ICE, an internal combustion engine, and making, 10% profit margin, they're losing 70% by selling electric. They cannot convert. The traditional guys are going away. We think that electric is at the tipping point, and Tesla will have its meaningful share. I was going to say fair share, but even more than a fair share, meaningful share of that market and be extremely profitable at it. But they need to get through this difficult economy, and the way to do that is by reducing price a little bit here. So we're comfortable with it.
It's also not just about hardware; it's also software too, and getting more into self-driving. And as you get more of a fleet and more cost, you're gonna eventually have subscriptions to the self-driving and generating $2,000, $2,500 a year from a couple million cars. That adds at a very high margin. That adds significant value to the company's earnings as well.
That's a great point.
Had a question over here.
Good morning. My question has to do with red lines. How do you decide when to exit? When you're looking at a company, you spoke about free cash flow. And when deciding those red lines, how do you adjust for stock-based compensation in the public companies that you look at? Thank you.
I can start. Maybe it sounds like there are two questions just with respect to the stock comp portion. I think we look at certainly think about every industry or every business relative to its peers, and there are different valuation metrics that are appropriate for different sectors. But unquestionably, at the end of the day, we're focused on free cash flow. Cash is king. Cash is king. And so everything that we do, whether we're valuing or looking at EBITDA earnings or other non-traditional metrics. We're always focused on the cash conversion, and cash flow potential of that business. Stock comp expense, again, varies significantly by sector and industry. We have noticed a very clear trend for businesses to start to manage down and restructure some of the way that they, provide stock compensation. I think there's a very real movement in the market to treat stock compensation, to continue to treat stock compensation as a legitimate real expense that's dilutive to existing shareholders. With respect to when we sell or when we're selling, I guess I'll make a couple of generic points and then pass it over. One is certainly we will sell, ideally in Baron Growth Fund, we'll sell positions when they reach some sort of price target and we no longer see the ability to double our money over the subsequent 4 or 5 year period. Successful investment, we're happy to exit. One. Two is sometimes something changes, a management team changes, barriers to entry change, the competitive landscape changes, the financial profile or growth profile of a business changes. If we believe that that has changed, we're happy to move on and reallocate that capital to another use. Sometimes we determine that we're wrong, that we've made a mistake. We do lots of due diligence before we make an investment, but we continue to do as much due diligence on names that we own and have owned for 15 or 20 years as we do for the cohort of new names that we're evaluating. To the extent that we determine that we were wrong, that our thesis didn't play out, we're happy to exit. And finally is simply capital allocation decisions consistent with the prior question. Capital is a scarce resource, so we're always looking for the highest and best use of that incremental dollar, and sometimes that involves selling something that we own to buy something else. Anybody else?
No, I thought that was a great answer. Touched on everything.
Great, there we go.
Let's see another question over here.
Good morning. Last year, when Elon Musk took the stage, the very first thing your dad said to him was, "I say to my wife, why is this guy still working?" Well, since your dad isn't on the stage here with us this morning, perhaps you two could answer as his proxies.
Let me do it, or?
For why does he work? Why does he work so hard as he does? He loves what he does. Just as we all love what we do and come to work every morning and wake up and make investments for the benefit of you guys. He loves what he does. I mean, I don't think the guy sleeps, but he's definitely motivated, and he's into it. He has a great team behind him for both Tesla and SpaceX, and just talk to them. Go meet the companies, and you visit Tesla, you visit SpaceX, and you see it's not just him, but he has a group of people around him who also love what they do, and they love working with him and really trying to grow both businesses. And you see it when you're there. It's quite obvious when you're visiting them.
I like to say Mick Jagger's still rocking and Ron Barron's still investing. We might have time for one more quick question before we have to get to the next panel. Very quick.
Yeah, I was noticing that, Andrew, in the asset fund, that 3 of your top detractors were still in your top 10. Obviously, you must still feel strongly about them. Could you talk about that? And secondly, with a lot of flows going out of stock mutual funds these days, did you have the cash to buy in at the lower prices on those 3 holdings?
Sure. I'm not certain exactly what period you're referring to in terms of the detractors. What I would say, and again, we don't have that much time. What I would say generically is, the stocks that are in the top 10 in my portfolio, and is probably true of the other portfolios represented up here too, are almost by definition the stocks that we have the greatest degree of conviction in. They're stocks in many cases that we've owned for the longest periods of time. They're the stocks where we have the most history understanding the businesses, the management teams who operate those businesses, the competitive dynamics in those markets, et cetera. So, generally speaking, when stocks in those top 10 are out of favor for reasons that are generally market-driven rather than company-specific in nature. That's an opportunity for us, in some cases, to add to those positions, but oftentimes not reflexive signal to us to be pairing those positions because they're out of favor for one reason or another. So what I would say to the second part of your question is, I think generally speaking, you're right, flows into the actively managed mutual fund complex year to date have been challenged by what's been going on in the market more broadly. I think fortunately we as an organization have sort of outperformed or sort of taken market share, so to speak, within the broader mutual fund space. So the flows in all of our funds have been, depending on the fund, either positive or in some cases modestly negative, but we haven't had sort of huge cash issues as a result that prevented us from taking advantage of the volatility I referenced to add to or seek out new positions that are compelling because of everything that's been going on in the market. And perhaps I'll have a chance to sort of follow up afterwards. I'm happy to go into more detail, but I see we're out of time, so apologies.
Thank you very much, and thank you for your confidence in Baron.
Thank you.